Okay, welcome back. Welcome to video number 20. And we're going to move on from the idea generation process now. We're going to move on to the second stage, which is extremely crucial, called gatekeeping. Now, gatekeeping is a process that is essentially used as a barrier between your ideas and your real capital. It's you putting up a barrier to try and stop yourself doing silly things, as in taking an idea and just putting the idea on straight away. So let's run through this quickly again. This concept that your ideas at this stage are just ideas. They're not trades. A good idea might end up being a bad trade, and a bad idea will usually just end up becoming a bad trade. So when we have a look at this, let's think of the example where we think we've got a really good idea, and we buy a stock or an asset at 100, and we decide that if it trades at 90, we're just going to trade out. So it goes from 100 to 90 and we trade out. We just put the idea on straight away, and it just goes to 90 almost immediately, within days. So we end up being forced to trade out. We essentially get stopped out. The trade hits our stop loss. But then that asset goes from 90 to 400. What you've actually just done there as a trader is the worst thing you can possibly do, which is you had a good idea, you put it on straight away, you mistimed it, and you were proved to be right, but you actually lost money. That's why we have the barrier of gatekeeping, to stop us mistiming good trades. But it's also to stop us entering bad trades. So imagine you buy this asset at 100, it trades at 90, and you trade out, and then this asset just goes to zero. Well, that's all fine that you overlaid some risk management onto it by stopping yourself out at 90, but you could have actually saved yourself 10 by just having a gatekeeping process in place, so you didn't actually enter the trade at all. With looking here at somebody generating an idea and just putting the trade on straight away. This is why we have a gatekeeping process. And the gatekeeping process is essentially two things: technical analysis, so using technical analysis to better time your trades and to stop yourself entering bad trades, and price action indicators. And the price action indicator we're going to look at here the most is the watch list, and the processes you use in your watch list to make sure that you enter good trades in well-timed scenarios, and you try not to enter bad trades. So whatever ends up in your portfolio stands an extremely high probability of making money. Now, up to this stage, what we've done is we've generated an idea or multiple ideas through the worldview, and the worldview has given us our view on the stock market, commodities, currencies and rates. And within the stock market, we've drilled down. We've gone from the index level through the sector level to the stock level, and we've drilled from the top down and combined that with some bottom-up analysis on PE. Now we're moving on to gatekeeping, which essentially is our idea cleansing phase. Is the idea correct in terms of timing? You might be early, you might be late. It might be original, it might be unoriginal. The point here is to stop yourself mistiming good trades and putting bad trades on altogether. Now, a lot of retail traders consider themselves useful and knowledgeable at technical analysis. That's all fine. You can put whatever technical analysis you want to put into this process. But the main point here is that we're looking at two things in terms of TA. Firstly, it comes in at the gatekeeping stage. It doesn't generate ideas for you. That's the first mistake. that retail traders always make. It's very, very easy to think that just watching a line on a chart will give you an idea, when in fact the line is just following the price anyway. The most important indicator is the price itself. Secondly, it's the misinterpretation of technical analysis or misinterpretation of a chart when you pull it up. So there's many scenarios that we're going to go through in the presentation where when you look at certain things in a chart, retail traders often misinterpret what they're seeing. And that means it becomes unuseful rather than useful as a tool. So let's go to the presentation. Let's take the first step in gatekeeping and look at technical analysis. And I'll see you at the end of video 20 with a summary of technical analysis TA. Okay, so let's move on to the stage of gatekeeping. So let's assume now that you've got tons and tons of ideas. You've got a worldview, you've got ideas in commodities, currencies, rates, you've got ideas in sectors, stocks. What do you do next? Obviously, everybody thinks their ideas are brilliant. No one shortlists a bunch of ideas because they're all rubbish. Everybody thinks their ideas are great. So what do you do next? You've got to put a barrier between yourself and your capital, your ideas and your capital. The idea of putting a barrier between your ideas and your real money is to stop yourself doing something stupid. What was the most annoying thing of being a trader that we discussed yesterday? When you're right and you lose money. So you buy a stock at 100 because you think it's a great idea. You get stopped out at 92 and then it goes to 400. If you have processes that put a barrier between your ideas and your capital, you're less likely to do stupid things. So what we're trying to do is go through these processes to time things in the best way possible. So when things end up in our portfolio, at least we've done the work, and if we're wrong, we're just wrong. It's better to be wrong and lose money than lose money and be right. Does that make sense? So what do? We apply a screening process of technical analysis, TA, and price action indicators. If all the planets are aligned and all those boxes are ticked, then we can seriously consider committing capital to this idea, to an idea. So this is what we're going to cover now, technical analysis in this part of the process. And TA is just one part of the gatekeeping process to stop yourself doing something stupid. First, don't confuse technical analysis with a tool that generates ideas. Retail traders are doing it in totally the reverse. All the processes are now in reverse to what professional traders do. So professional traders will start at the top and work their way down, then pull up the chart to see if the chart agrees with what they think. So your fundamentals come first. Your world view, your industry view, your sector view. Your stock view, you pull up the chart. Not pull up the chart, take a position, when it goes wrong, then work out why, then justify it, then get a world view, and then put it in your pension, and it goes to zero. That's the reverse order of doing things. So don't confuse TA with a tool that starts and generates new ideas. The vast majority of technical analysis indicators react to the price. They follow the price. The price itself is the indicator that's important. So it doesn't give you trade ideas. What it does is it gives you a pictorial representation of what's happened in the past. And might give you some clues as to when you can time your entry to the trade. It's not useless, it's quite useful. And we'll go through some of the TA stuff that you can look at to time positions a bit better. Try to think of it as a traffic light system, where you've got your fundamental view on something, where you think the world's going to go up, for example. You think a sector's going to go up, you think a stock's going to go up, then you pull up the chart. And the chart literally says, there's no way you should be buying this at the moment. It's a red in the traffic light system. Just stick it on your watch list. When the technicals move in your favour, then the timing is better. If you pull up the chart and technically everything agrees with what you're thinking, and it looks like a great entry point, don't be afraid to commit some capital to it. It means it's a decent idea. If it's amber, you could just be too early, same as red. It can go on the watch list, or you might take a starter position, what we call a half position, a starter position, where you say, well, my ideal size in this situation is to maybe buy £10,000 worth, but at the moment the technicals are neither here nor there. So I'm going to buy £5,000 and just see what happens, and put quite a wide stop loss on the trade. Give myself a chance of making money. The contribution of that position to the rest of your portfolio should not hurt you in the short term. Big mistakes of TA. First one we've covered, getting a trade idea from a chart. It's totally amateur. Two, going short of an asset that you're fundamentally bullish on because the technicals are bearish. So you pull up the chart and the technicals look like the stock is going down. But everything you've done up to this point says that stock a year from now will be higher. And you get convinced by the chart to short it, and then it goes through the roof. Vice versa, going long an asset that you're fundamentally bearish on. You pull up the chart, it looks like technically everything's great, and it looks like it's going to go up forever. All the work to that point you've done is bearish, and you get convinced by the chart to buy some, and then it halves. Again, no worse feeling in the world to know the real situation, be right, and lose money. This happens time and time again, even in the professional world. That's the type of stuff you get fired for. Where you walk into an office and ask for an increase in capital because you've done loads of work on a situation and you're fundamentally bullish on it. And then the chart sucks you in to be short. And then you end up losing money. You'll get fired for it. So before you pull up your charts, you're going to have fundamental predispositions. Now this is where you have to be careful. Because when you're fundamentally bullish on something and the technicals aren't quite there, or fundamentally bearish on something and the technicals aren't quite there, you're better not to participate at the moment. But when you've got fundamental predispositions, it's very difficult to control those emotions to stop yourself doing stupid things. You have to just stick it on the watch list and wait, and be patient. Nothing wrong with being patient. You can end up buying a stock higher than where it was when you first started looking at it, but the technicals are all in your favour. The risk reward on that trade is now better. So, in terms of technicals, you can get as complicated as you want. If you feel the need to get complicated on technicals, and you know much more than me about TA, which some of you probably will, feel free to add it into this section. But see it for what it is. It's a chart. And the chart follows the price. All the technical indicators follow the price. The price is the most important. So you can add any amount of technicals into this point where you want, anywhere you want. That's fine. But make sure when you're looking at TA, you treat it for what it is and put it in the process at the right, where it belongs. Don't work backwards. Start with technicals and then find out fundamental reasons why you should be doing something because the chart is telling you to do something. So often technicals will tell you as much as what not to do as to what to do. So given your fundamental predisposition of being bearish, do you short the stock when you see this? No, you wait for it to break. If your fundamental predisposition is bullish, this is going to this confirms what you think. So you're now looking for entry around trend, if you can get it. Trending stocks downwards. If your fundamental predisposition is bullish, do you buy this? No. No. Stick it on the watch list. Wait for it to break up to the upside. Wait for it to break the trend.
So, what if it breaks in a month's time? Do you?
Then it becomes. Then the risk reward on the trade is probably better than it was before.
But do you have to make a new fundamental analysis on what you did a month ago?
Yeah, you'll look at it again to see if anything's changed.
Is it worth buying at the bottom of the channel? Would that still be a valid entry?
Well, who says it's the bottom of the channel at that point?
I mean, if I see a channel like this and...
No, you're fighting the trend. You're fighting the trend because the overall trend is down. You better if you got a bullish fundamental predisposition and this is the chart you pull up, you're better off waiting. Just stick it on the watch list. You know, well, you've got to look at it in the context of all the opportunities in the world. Yeah, 40,000 stocks in the world, 40,000 assets in the world, sorry, equals 40,000 opportunities, and actually 40,000 to the power of 39,999 opportunities, because you can have lots of spread trades. So there's literally a limitless amount of opportunities in the world. If your fundamental predisposition on this is bullish, just time it better. Try and time it better by waiting for the price to confirm what you're thinking. Because you know, we're trying to predict what's going to happen in 6-12 months' time. When you start seeing it slowly happening, that's when you become convinced that it's actually getting to be a correct situation. Yeah? What about ranging stocks? Or ranging assets? If you've got a fundamental predisposition that's bullish, what do you do in this situation? Huh? Half position? So would you say this is an amber on the traffic lights? Who says it's an amber? Who says it's a red?
It's a red because it hasn't broken from the channel yet.
Who says it's a green? You just go in full position. It's a bit subjective, ranging stocks. It's somewhere between watch list and a half position. Why? Well, all that is telling me is that someone in the market thinks that it's cheap at 6. That's why they're buying it. And someone in the market thinks it's expensive at 8. That's why they're selling it. But there's no such thing as cheap and expensive. So you might wait for it to break out before you commit, or you might commit a little bit. Doesn't really matter. What that's telling you is that the market's a bit screwed up at the moment. Does that make sense? Why is it screwed up? Because we know that there's no such thing as cheap and expensive. That stock in 12 months' time could be at $40. And that range is totally irrelevant. You'll see this time and time again in the markets. Head and shoulders formations, where you've got a left shoulder, a head, and a right shoulder. What's actually happening in the price? Well, you've seen a bullish trend in the past, and you've had a blow off top. And now the price momentum is slowing down. And at this point here, it's broken what's called the neckline. And in technical analysis, what you would expect is a move to the downside that's around the size of the head from the neckline. So the head from the neckline, $8 to $11. So a drop of $3. If your fundamental predisposition is bullish, and you see this, and you're here, do you buy? No, stick it on the watch list. If your fundamental predisposition is bearish, and it's broken the neckline, what do? That's a bright green light. Go in big. And put your stop loss above the neckline. What about reverse head and shoulders? Your fundamental predisposition is bearish. And you see this. Red, amber or green?
Red.
Very bright red. It's going up $3. If your fundamental predisposition is bullish, green. So again, it tells you as much what not to do as what to do. When stocks put in double tops and double bottoms, and then you see a breakthrough, a double top, and you see a breakthrough previous support. It's exactly the same way as everything we've looked at already. Fundamental predisposition of bullish, stick it on the watch list and wait. You might be right 12 months from now. The stock could be $30 in 12 months. But at the moment, the timing is poor. You want to see that stabilize and break in some way back before you take a position. What about a double bottom with a breakdown? A false breakout, we call it. Fundamental predisposition of bullish. What do? With a false breakout? Neither here nor there. It's an amber. Stick it on the watch list. If it goes a bit lower, maybe you might buy some around support. Fundamental predisposition of bearish. It's amber or red. Just let it break support and short it. You want momentum behind your idea. You'll see a lot of these bullish flags where basically buyers have stepped into the market and now they're trying to get cheaper prices, but they're still there. And then it breaks the channel to the upside. It's a flag formation, a bullish flag. What not to do? If your fundamental predisposition is bearish, short on a flag breakout. Fundamental predisposition is bullish, buy on a flag breakout. What about a pennant formation? A pennant formation is just exactly the same as a flag, but converges in a triangle instead of a channel. Fundamental predisposition is bearish here. Don't do anything. Stick it on the watch list. If your fundamental predisposition is bullish, get involved. Don't be afraid. Totally the opposite. Bearish flag, opposite of bullish flag. Sellers have stepped into the market. They're trying to sell for higher prices, but then eventually they have to accept lower prices. If your fundamental predisposition is bullish, the momentum here is down. Do nothing. Stick it on the watch list. Your fundamental predisposition is bearish, jump all over it. Same with a bearish pennant. What about with volume, when you look at volume? So it's the same again. Large moves in assets combined with big amounts of volume or higher than normal amounts of volume. If you're bullish in this situation and you're seeing big volume in this move, as in the highest volume it's been for a year, and you're bullish, you're better off waiting. You need that to stabilize before you actually commit. So instead of buying it here on huge volume and being stopped out here, you buy it for the same price here when you've got the momentum to the upside. When there's low volume, what if you're bearish? It's a great signal if you're bearish. Get short. Relative strength index. Who knows about this? So the average of the previous market convention is 14 days. The average of the up closing prices and the average of 14 days down closing prices indexed. So standard RSI measures will tell you that if it goes over an index level of 70, it's overbought. If it goes under an index level of 30, it's oversold. But that's completely the wrong way to look at it. Because the stock can be above 70 or even 80 or even 90 on the index and just go sideways in price, and then the index can go down to 50. So the price might never come down. So it's not overbought, and inversely it's not oversold. That's the wrong way of defining in terms of what's happening in words. It's the wrong way of looking at it. What's happened when the index level of an RSI goes above 70, 80, 90 and is really strong, it's just confirming your bullish view. And you could actually miss the trade. So you have to combine it with other technicals. It's a momentum indicator. Combine it with the technicals of trend that we've just looked at. Yeah? And make up your mind whether it's a good time to go in or not. Because short-term momentum just confirms your view. And the stock might, the asset might never ever come down in price, but the RSI can. Just the momentum becomes slower, but it keeps going up. Make sense? What about moving averages? So we can use exponential moving averages. If you want to add that in, that's fine. But we'll look at simple moving average, SMA, just to get the principles covered. So it just tells you whether momentum is building in the asset or not, or momentum is slowing down. So if you look at a typical situation where you're looking at very short-term moving averages, where you've got 10 closing prices of data over the last 10 days, 6, 5, 6, 7, 9, 8, 8, 10, 13, 16. The 10-day moving average of those closing prices is 8.8. That's a simple average. The 3-day moving average is 13. So the last 3 days, 10, 13, 16. But if you plot a 10-day and a 3-day moving average, what would have happened on day 6, 7, the 3-day moving average would have actually cut the 10-day moving average from below. So when you get those crosses in the moving averages, it confirms your view, if your view is that it's going that way, but it denies your view if you think it's going the other way. Again, you're going to have your fundamental predisposition. So you can either hang back or participate. You are the gatekeeper, nobody else. What are the moving averages that we use in the stock market? Has anybody ever heard of a golden cross? Anybody ever heard of that? When a 50-day moving average crosses a 200-day moving average. Yeah? When you go into the market, you'll hear a lot of people talking about 50-day and 200-day moving averages. But what is 50 days and what is 200 days? You've got to start reading between the lines. Always question what it is. What does 50 days represent? Huh?
Number of trading days in an entire year, 200.
How many trading days are there in a month? 20. So it's not a quarter, is it? What's 50?
20 multiplied by 3.
But what's 50 days? Why do people in the market use a 50-day moving average? What does 50 days signify? Huh? Okay. So what does 10 weeks represent? Okay, let's move on to 200. What does 200 days represent? These are the most common used moving averages in the market by technical analysis themselves, right? What does 200 days mean? And don't say 4 times 50.
Well, doesn't they use 200 because it's like the number of days where there's no big structural change in the economy and like everything that happens is still relevant?
Okay. So why not 199 days? You just hit the nail on the head because it's a round number. It literally doesn't mean anything. It's a trick question. 50 doesn't mean anything. 200 doesn't mean anything. So what are the meaningful moving averages in the stock market? What are we trading here? Stocks. And they're in the stock market. How many trading days are there in a month? 20. So that's one of our important moving averages. How many are there in a quarter? Stocks report quarterly. GDP's reported quarterly. We're trading the stock market. 1 quarter, 60 days. How many days in a trading year? How many trading days in one trading year? Depending on the year, 250, 251, 252. So 250 days. That's 1 year in the stock market. And companies report quarterly and GDP is reported annually. 50-day means nothing, 200-day means nothing. So all you'll see is loads of people talking about the 50 and the 200-day. They'll all trade for about 3 hours and then they'll all disappear. So what happens if you've got a fundamental predisposition of bullish and a 20-day moving average crosses a 60-day moving average from above, as in momentum's down? Well, that just means your 1 month moving average has crossed your 3 month moving average, signifying that in all probability for the next quarter, the price momentum is going to be negative. And what happens if a 60-day crosses a 250-day? So your 3-month moving average crosses your 1-year moving average from above, and you're bullish. That's telling you you could be wrong for the next 6 to 12 months. So it might not even be a starter to even put it on the watch list. But feel free to put it on the watch list if you want. It could take 6 months for the momentum to play itself out in the asset. When you come across technical analysis in the market, just sit down, ask the obvious question. What is a 50-day moving average? It just doesn't mean anything. What is a 200-day moving average? And overlay that with your own objectives. What's my objective? My time horizon is 1 to 3 months. And I trade the stock market. So if I trade the stock market and there's 20 trading days in a month, 60 in a quarter, and 250 in a year, and I'm trading companies that report quarterly on GDP views that are reported quarterly and annually, what are the most important moving averages to me? Just ask the obvious question. So you can add any TA indicator in there you want, but that outlines the approach. Your fundamental predisposition, whether it agrees, confirms or denies what you're thinking. That's going to stop you doing something stupid, i.e. buying something at 100, getting stopped out at 92, then it goes to 400. Feel free to add anything in. Don't confuse TA with a tool that generates the idea for you. You need to have your view before you pull up the chart. A good trade is going to be one that agrees with your worldview, agrees with your industry view in the stock market, and your stock view, and technically is starting to work. That's when all the boxes are ticked. That's when all the planets are aligned. That's when you say, as the gatekeeper, I'm happy now to allow capital to go into this situation. Your idea can be a great idea, but it can be a badly timed great idea. So be the gatekeeper to your own capital. That's the first screening test, TA. Okay, welcome back. So we just went through at the presentation technical analysis as part of the gatekeeping process. Now, when we go through TA, we obviously are looking at it as one of the most important timing indicators to good ideas and also stopping us from putting on bad ideas. So the whole point of this really is to use TA as a tool to add value to our idea, as in to turn an idea into a good trade, because a good idea might not necessarily be a good trade. You can end up being stopped out on a good idea because you've mistimed it, and then you're proved to be right. We've been through this a few times now. Probably the most important thing here is your fundamental predisposition. So when you go through the world view, the industry view, the stock view, and you arrive at the gatekeeping process, and your idea is ready to be turned into a trade, potentially, you're going to have a fundamental predisposition. And probably the worst mistake you can ever make is to then pull up the chart and then change your mind. Just forget about it. You're going to have lots of ideas coming through your pipeline of ideas constantly, because you're going to have these processes in place and you'll be deploying these processes on a weekly basis. And if you pull up a chart and the chart does not agree with what your fundamental predisposition is, that doesn't mean it's a bad idea. It could be one of the greatest ideas you've ever had. You just need to stick it on the watch list, and you just need to wait to time it better. So please make sure that you do not go against your fundamental predisposition when you pull up a chart. That's just a really, really amateur mistake. So technical analysis as part of the gatekeeping process, just to summarize, is this one of these things that you put up as a barrier between your ideas and your real capital before you commit money to a trade. You're trying to use it as a tool to essentially add value to your potentially good trade, because at the moment your idea is just an idea. Now we're going to move on to the next one, which is price action, and we're going to look at how you develop your watch list and the processes that you go through on a week-to-week basis in terms of generating your watch list and making sure that your watch list is up to date and it's serviced correctly in terms of providing you with trades, as in your ideas are on the watch list and your watch list then provides you with trades alongside your technical analysis. Okay, let's move on to video number 21 and I'll see